Today, we're breaking down what might be the biggest threat to the US economy right now. Not war, not inflation, not even tariffs. I'm talking about the national debt. Yeah, I know it sounds like some boring government problem, but stay with me because this is the kind of slow moving disaster that can hit everyone's wallet when it finally snaps. Now, look, Trump may have inherited this mess, sure, but he's also making it worse with his push to extend the tax cuts and bring back tariffs. And that's not just a US problem anymore. Other countries are noticing. China and Japan, two of our biggest lenders, are already dumping US treasuries. And global trust in the dollar? Yeah, it's not what it used to be, especially with Trump stirring up talk of new trade wars. If foreign buyers keep pulling back, the US has to do one thing to make our debt attractive again: offer higher yields. That means higher interest rates for everyone: mortgages, credit cards, car loans, you name it. So, what does that mean? It means we're drifting closer to a market correction. The debt is ballooning, interest payments are exploding, and the Fed is trapped. They can't cut rates too soon, or inflation roars back. But if they wait too long, the debt bomb grows and becomes even harder to defuse. And part of the reason we're in this mess? Let's go back to Janet Yellen, former Fed chair, then Treasury Secretary. During the pandemic, when rates were basically zero, she had the chance to lock in cheap long-term debt. But instead, she mostly issued short-term bonds, 2 years or less. Now we're refinancing at much higher rates, and taxpayers are footing the bill. Why'd she do it? Maybe she thought rates would stay low. Maybe she didn't want to rock the mortgage market. Or maybe her experience at the Fed made her overly cautious about the long end of the curve. Either way, it was a big mistake. Now it's Scott Bessent's job to fix it. He's trying to issue more 10, 20, and 30-year bonds to lock in today's rates. But here's the problem. The more long-term debt we sell, the more investors demand higher yields, and that pushes up borrowing costs across the board. It's like trying to sell hot dogs on a street where everyone else is selling hot dogs too. You've got to offer more just to get someone to bite. If rates hit 6% or 7%, the US budget starts to crack, and then the Fed might step in, not by raising taxes or cutting spending, but by printing money. They call it monetizing the debt, but it's really just creating money out of thin air to pay off what we owe. And yeah, that leads to inflation every single time. But here's the upside, maybe even the escape hatch: Bitcoin. When this pressure cooker finally blows, when the Fed cuts rates again or fires up the money printer to bail out the system, BTC becomes the hedge. It's not tied to governments. It doesn't care about debt ceilings or treasury mistakes. It's scarce, decentralized, and global. And more, it's starting to look like digital gold. So yeah, watch the yields, watch the Fed, and watch Bitcoin. Because this debt storm might shake the markets, but it might also be the rocket fuel that launches BTC to the next level.